This is the number one action that you have to take to make sure your company does not go bankrupt. Today, we're going to be investigating income statements and balance sheets, showing you guys how we grade them and what we use them for to make sure we're investing in a good fundamental company and a company that's going to give us a lot of returns in the future based off past results and the future that they're going to provide with the security of the balance sheet. Just before we go into this and get into the company's grading, we're going to go through what the income statement provides first. The income statement gives you the quality of earnings. Are they actually coming from core operations, or are you getting one-offs or tax breaks that actually make that earning period look really good and their EPS huge when that overall company actually isn't doing amazing? Another thing you need to do is you need to know margins. Margins are so important for a company because they show if you can price power. So say a company comes into the sector and say you're Tesla, for example, and some other EV company comes in. Are you making enough and making your cars for as little price efficiency wise to be able to bring down your prices in half to stop this other company from taking a bunch of market share from you with their lower prices? And also, it just shows, is the company operating efficiently? Are you spending too much on SG&A, marketing, or are you actually getting organic revenue for something like an Airbnb that has a network effect that people hear about them and want to go on and use them? So that's what the income statement can provide. So we're going to go through what we're grading these as right now, and then we're going to go to the balance sheet stuff later. So for anyone who doesn't know, this is the company AMD. They're a chip maker a little bit behind NVIDIA. So we're going to go through their balance sheet and their income statements right here. And we're going to give you, we already have projected out the numbers of what it changed. So we're basically taking the December 27, 2025, and we're comparing it to this number, so a year in the past. And what we're really looking for at the top of this is their revenue. So we want to see their revenue going up year over year, because I just want you to ask yourself, if you're investing in a company, do you really want to be investing in a company that's losing money on the top line, meaning their whole operations are shrinking? And then you want to go and you want to take the cost of sales. So basically, we're going to color code it green, yellow, or red here. Green is good. Yellow means if your cost of sales is less than net revenue. So you see how net revenue went up 34%, and then cost of sales went up 26%. That's yellow because that's actually good. That it's still going up, but it's going up at a less clip than revenue. So it means that they're efficient and they're making money on their operations with those products. And then you want to kind of go down there to see the total cost, because some companies are going to have different additions they have, like this amortization, but that's not that huge line item charge. And then this is huge. You want to see this gross profit margin. You want to see that going up. So you see one from 51% to 54%, and gross profit went up more than the cost of sales there and more than the cost of revenue. That means they're efficient in their process of making this. So they're actually making more and more money every time they make more products, because they have something called operating leverage. So operating leverage is just, say you had to pay $100 to open your lemonade stand every year, right? And then your variable costs might be something like how much lemonade packets you have to buy, and the amount of time that you put into paying your employees are all your variable costs. So basically, this gross profit goes up, shows that you're going to have leverage over those fixed costs with your variable costs not being that much with this margin going up. And then we're going to go down there. So that's why that's green. It's bigger than this net revenue. Then we're going to go down here, and the research and development is a 36. So that's a little bit less than the total gross profit. So that's a yellow right there, hand in hand. It's just right around that. Not red because it's not hugely bigger than it. Like you see with marketing here, went up 53% year over year, which is not what you want to see, but it's such a small line item. And if you're chasing a company like NVIDIA, that's why you have to know the company. You need to know they need to market it and get new products and break into that sector more. So that's a red line item, but it's nothing horrible to see because it's so small and way less than that net revenue. So your margins are going to keep getting better and better. This is actually great to see. This is green because this actually went down year over year. So that's why it's green. Whenever something goes down that could subtract, that's whenever you give a green rating. And then, so your total operating expenses is a yellow still. They went up, but they went up at less of a clip than revenue and less of a clip than your gross profit. So that's exactly what I want to see. That's even more leverage now in operating leverage. So your operating expenses are going to be, like we said, the research and development, SG&A is what you're kind of going to see in there. Sometimes your interest expenses and everything are going to be in this. If you're having to pay like amortization or depreciation, is where you're going to kind of find those type of stuff, which some interest will be in there, some will be on a different line in the income statement. So what we did here is we see operating income went up 101%. It doubled over the year. And that's so good because look at how much, that's 3x more than the net revenue went up. So that shows that Lisa Su and the company and the management, you can evaluate them and say, hey, they're operating super, super efficiently. And their return on equity and everything is great for this company. And then, so that's a great thing you want to look at. You just kind of want to look at whenever you're going down it, net revenue. And then the next biggest line on them is cost of sales is huge, but you want to see that gross profit really tells you what is the cost of sales doing. And then the operating income, that is the next huge thing, even bigger than the gross profit, because it's showing are they being efficient here, and that you want to see getting bigger and bigger, like we've been preaching. This here, big, gross profit's bigger, operating income's bigger, and then you go all the way down after taxes to net income went up a whopping 213%. That went up, that means that's huge for this company. Whenever your revenue is only going up 34%, which is still a great clip, don't get me wrong, they're going to start expanding those growth rates and get better than NVIDIA, but this isn't a video about that. Net income up 213% is exactly what you want to see. That net revenue, gross profit, like we've been preaching, bigger, operating income bigger, then net income is even bigger than that is what you want to see. And then even better, the last thing you want to do is you always want to use diluted earnings per share because companies are going to be diluting shareholders, issuing more shares sometimes. Some of them are buying back, but you never know. So you always use that diluted shares. This being bigger than net income is even better because it shows that the share count for the company is going down. Because if you know something about EPS is earnings per share basis, so net income divided by shares outstanding. If you have less shares with the same net income, your EPS is better, and EPS better times the P ratio is a higher share price for your stockholders. So just think of that in your mind. That's how you want to look at it. If I had to grade this, A+. There's only a little bit here of marketing. That interest expense does not even matter. But overall, these margins get so much better down the board, and that's exactly what we're looking for, and there's no red flags or anything. So that's huge for this. A+. This next one we're going to go through is another company we absolutely love, SoFi here. Like we were saying, you want to go through, think about it at the top. Green income, total interest expense, red though, because it is bigger than these two, how much they went up. But your net interest income is still 50%, which is pretty great. And that's going to be green there. And then you just go down here. Loan origination is red because it's still going up a little bit, but nothing crazy. Sorry, it went down. But you kind of got to know the company because they're transitioning out of that, and they're kind of selling off a lot of their loans. So that's why before doing this, you always have to read through the 10K. I want you to imagine you're going to a baseball game or something, and you're going to try to pick the winner of a team, right? You're not just going to run into the baseball game, sit down, and just look at the teams and say, hey, this team's better because they're taller or something line up. No, you're going to want to go do your research about the team. How are they doing better? Was their pitching good or are their batters good? So it's like anything in life. You got to do your background research first and get to know them, and then you use the numbers to make your predictions for it. After that, loan platform fees, like we said, fee-based revenue for those loans went up. That's exactly what you want to see. If you know the company, that's perfect for it. And then now we're going to the expenses. Banking is a little bit weirder. Look at these. They kept these all in check. Way on a lower clip than this 50% of income. 15, 35, 26. So all the operating expenses were way less. So that's exactly what you want to see for a company. They're not more. They're operating efficiently in Anthony Noto and Get that gives you in the company. And then here, this is a weird one, right? Because you say, hey, why in the world are you giving this an A+? But this EPS actually went down from last year. That's why you got to be good at reading these financial statements and see, hey, what happened last year, right? This here, they actually had net income tax. They got paid it. Last year, they had a tax break of this number right here. So that's why their net income looked ginormous, like $332 million. And this year, it only looked as $173 million. But their income before taxes was $185 million compared to $59 million. And that is a 213% gain from there. So that's what you want to look at here, because there's always going to be stuff happening. Some companies are going to get tax breaks. Some, like last year, like you have Microsoft, Meta, and them, they got taxed higher for who knows why, but they just report it. So that's just, you got to run it and do the math and say, hey, this number doesn't make sense in my head right now. So that's what you kind of got to get from there. And then you can see that they're just expanding on every line item, like we said from the top. Bigger, then this gets to bigger, and then this would have been bigger. So that's exactly why we're giving them an A plus, because they hit all the boxes, kept their spending in check, and nothing stood out like a complete red flag on the statement. So we showed you 2 A pluses. Let's take you to another company where you're really gonna have to do some investigation and shows you how to really to go about this. The next company here is Celsius. So we're gonna go and look on the top line. What do they do for the revenue? 173% gain, right? Good. Now I want you guys to be sitting here thinking, cost of revenue is 153% increase over year. What would you say? Is that a good thing or a bad thing? If you guys guessed right and you know it, that's a good thing that it went down less than revenue. And what does that do? If you know anything about margins, if your revenue is higher and your cost of revenue goes up by a lower clip, your gross profit is going to go up and your gross profit margin is going to go up. But then after this is where this gets funky. There's a one-off here where they have a distributor termination fee because, like I said, you have to read. If you're going to a game or you're going to go and make a prediction on something, you need to read behind the lines. Basically, they acquired Alani, so they had to pay this fee. But if you even go look online, you know who's paying the fee for them? Pepsi. So that's just going to be off their books eventually, and Pepsi's going to pay them back for it. So even though it hurts them right now and makes it look like they have a loss of operating income, they actually would have been up $166K from a negative 3,000, which is however many $1 million loss. So that's a huge increase, and that's exactly what you want to see for a company like this, keeping all this in check. And you got to read around it. And this is actually an amazing buy, because what happened whenever this happened, the stock went to $37. And then once they realized, oh crap, we messed up with the algorithms, we shouldn't have sold this off, that's whenever the stock just flew up after. So this is something that you can take advantage of as an investor whenever certain stocks get sold off, because people don't go and do their due diligence and research, which is why you have to go through these statements and understand what is going on. Are they going to have to be paying these? And that's how you're going to get an edge above these companies and go in the future and get immense returns and make your portfolio bigger, while other people are sitting there saying, hey, I need to be selling this. This company went down $75 million worth of operating income. So that's just something you have to see. And then we even did this formula here. Right here, if you go down, I mean, everything's red because they were kind of paying off some stuff here. In the provision, negative 0.27 EPS. But if you really did the math here, just read through this, look over the math for yourself, using that 166K, minusing all these and doing the right tax rate, they really have had a 0.49 EPS, an increase of 1,000,000% or infinity percent from zero. So that's what you got to look at for these companies and understand that you got to read in depth and inside the lines and find things that other investors are not going to see, because it's just math and it's going to allow you to get an edge among the competition if you find this in listening to their earning reports or conference calls or anything. So that's why you really go through these. And then obviously here we give it a B plus because they did have a little bit of excessive spending up on here, probably because of the acquisition. But overall, this is a pretty good sheet, and you kind of want to take this and say, hey, what did they put in last quarter and what did they put in now, and say, is it a better grade now? And that means that company's getting more efficient. You have more trust in the management. So let's just go back here, and now we're going to go to the balance sheet. The balance sheet's a huge thing, right? So say you're invested in a company right now that has a huge amount of debt, or something like MSTR that's super levered up in something crypto, right? And their balance sheet is just crap. Or something like Oracle that has so much debt on the balance sheet, that's why they got sold down. You're not going to sleep good at night, because think of what happens, right? You have a bunch of money on debts that you can't pay and you're going to refinance. What in the world happens if we have an inflation crisis like we possibly could with oil right now and the Fed has to jack up rates? What's going to happen if you have to refinance your debt? You're going to have to refinance for 5-6%. And then you go to this income statement over here, right? What's going to happen to your interest expense? Because that's the bottom line that leads to net income. It's going to get jacked way up. And then what's going to happen to your net income and EPS? They're going to go down. And what's going to happen whenever your EPS goes down? Your stock price goes down. So that's why it's so important, the balance sheet, that you can sleep good at night and say, hey, if this company goes into bad conditions, good conditions in the market, they don't have that much debt on them, or they can pay off their debt with cash, so they're not paying a crazy amount of money leaking on their net income, or they're just not going to go bankrupt and have to default on everything, and your investment goes to 0% after liquidation because you're a common stockholder, so you're probably going to be the last person to get money. And then other things you need to do is liquidity. Like I said, how fast can they turn assets into cash if they ever had to pay off their debts or something happened in the market? And how efficient is this company in using their assets and turning that into actual revenue? So we're going to go right here and we're going to go into AMD. So there's a few things we're looking for on the sheet like we've been talking about. We did kind of all the ratios for this one just because it's a little more complicated. You don't have to do the ratios, but it's a good thing to do for companies if you can't easily understand what's going on or if the numbers are close at first. So we kind of did it for you guys here. So we did cash and cash equivalents went up. Short-term investments went up by a lot. Great things to see, because imagine you have a short-term investment as a company. You're probably in bonds, T-bills, or something, right? You're probably getting a yield on those, I don't know, 3, 4, or 5%, depending on the interest rates at that point in time. That what happens with that interest, that's why you sometimes will see companies have interest income on their income statements, because they're making money off of their investments. That's huge because it could help their net income. Or say you're something like a Celsius, and if you know anything about the industry, I don't know if you drink Bloom or something, Celsius might have to end up buying them in the years. So if you have a lot of cash on hand on your balance sheet, you can actually acquire the company like they had to do with Alani. So that's why it helps. Your company can get new companies and stove off competitors and keep their margins and get back some acceleration and growth. So that's why the balance sheet is so much more important than anything you're going to read about a company. Because are you going to sleep safe at night? Are they going to get beat out of the industry? Or can they buy off their competitors? So after this, you want to see those total current assets going up because, right, the current ratio, current assets divided by current liabilities. And whenever you're looking at just current liabilities, I mean, these are fine. They stay there. Obviously, you don't want to see it going up too much. You want to see it going up at less of a rate and the current ratio getting better. Like you saw here, 2025 is better than 2024. So that's a good sign to see for companies using the balance sheet efficiently. Then you also want to do your quick ratio. And also another thing you want to look at for the company is just how is this long-term debt going up? Is it staying there or is it going up on a complete pace? Are they borrowing too much and they might have to pay down and dilute shareholders later? So that's just another thing to look at on the line item. Long-term debt, short-term cash, current assets, current liabilities, total liabilities. And then you also want to look at your total stockholders' equity, because that's assets minus liabilities. So you obviously want to see that being huge and getting bigger, so it shows you the cushion with the company and that they're not super levered with debt or anything or on leverage. So that's what you want to see. Quick ratio did go down, but there's also reasons. There's always little stuff sometimes you got to read into it, but it's nothing too crazy of a sign if you see everything else is a green. And then if your cash ratio went up, cash to debt, that's pretty good also. That means you're having more cash on hand, which you saw how much cash and short-term investments increased compared to this debt here. So that's what you want to see. If we had to give this company a grade, it'd be an A. The only thing I would have to say is maybe that quick ratio wasn't as good. But AMD, I'm going to sleep good at night. I'm not going to be worried about their situation if we go into an economic downturn. I'm going to be buying more. They're not going to get bankrupt or anything. Next company here, we're going to go through SoFi. This is an unbelievable balance sheet, let me just tell you. This company, for a bank even, that usually have a lot of loans, this company's an asset light is what they transition to, but I just want you to take a look at this beauty of a beast out here. So their cash went up almost 100% and doubled year over year, which is unbelievable. You want to see. Investment securities, 36% increase. Green. Their total assets looked up by how much they went. Goodwill didn't budge at all, which is also a huge thing. Goodwill is the easiest thing to fake. So it's basically you're saying you're paying, if a company is worth $10 and you pay $15, you're going to say, oh, I paid $5 in goodwill for that. Or you're going to say, oh, I have this formula that no one else has and I can calculate it as intellectual, intangible, or goodwill. So goodwill is the easiest item to fake on a balance sheet. So that's always something you really, really want to keep a lookout for because that could be dangerous. And then this gets even better. Their debt goes down by 70%. Unreal. They're paying off their debt, which is why they've been diluting, which, what did we say? Whenever you're not paying as much money interest on the debt, that actually leads you to be able to make interest income on investments to even cancel out that debt. So you don't have to pay any interest income, like right here, an interest expense that AMD had, leading to a lower bottom line net income and a higher earnings per share because you're not diluting and you're not paying out interest expense. And then we saw this total shareholders equity go up by $4 billion. Beautiful. And we saw total liabilities per 14. That's great. That's exactly what you want to see with the company. A++, especially in the banking sector, you really need to make sure they have good balance sheets. Because how many times a year do you hear about banks going over or someone having some problems? Like right now, Blue Owl, the Lehman Brothers went down. Silicon Valley's had a few banks there that in crises. So banks, you really, really, really got to make sure they have good balance sheets, because if you think a recession happens, they're the ones loaning out money. If people are defaulting or anything on that, they're not making money, and their balance sheet's getting screwed. And that's why you get dangerous, and a lot of them trade at low PE ratios. But SoFi trades higher because they're asset light, so they get paid for those fixed loans. They sell them off to other companies, so it's a fee-based recurring revenue fee. Then now this last one you want to go through is Celsius right here. So the only thing with them, this is a little of a red flag if you don't know the company. Like we said, what happened? Celsius bought Alani. So that's, you have to know your company in and out first. You can put ideas happening in the real world to other items on the balance sheet. Cash and cash went down, which isn't what you want to see, but they did do an acquisition. It's going to get built up as Pepsi repays them back money. You also want to look at like this. This is restricted cash. That's what happened. A lot of it is in there, so that's okay. Account receivables went up, which is also what you want to see. It's factored in some of the ratios. So account receivables, money you're going to get paid in the future. So that's another good thing that you want to see going up. And their current assets did go up, so that's good. We do not like this though. The goodwill went up because basically what I say, they probably overpaid for Alani and they're putting it on there. So just because that's the reason total assets did go up by a lot, it's okay. I don't love to see that. It could be a little bit of a red flag, but you have to understand companies are going to do this in their situations. If they acquire a company, goodwill, then maybe it's okay, but you don't want to see that on there going up crazy quarter in, quarter out. Then that's like what's going on right now. This is a one-off, like that distribute. You can match this distribution fee, right? With right there, distributor termination fees on there. So that's a one-off right there. Their accounts payable didn't do anything too crazy. Their accrued promotional allowance went up there because they're trying to go and advertise. And their current liabilities did 4x, which isn't great to see. But there's other reasons for this outside. But you also have to understand you can't fall in love with a company and like take it for granted, which we don't completely love this. But it's okay. Their long-term debt also did go up because they probably took out to pay. You need to look through that. And their total liabilities did go up by a lot. The only good thing is their total shareholders' equity did go up. But overall, if I had to say, we would give this like a C plus, B minus. So it's not great. But with that all being said, they could almost cover their current liabilities with cash. So cash ratio is almost there. They do have their quick ratio. So current ratio is total current assets divided by total current liabilities, which is higher. So they're going to be able to pay that off. The long-term debt, and there are some red flags that to keep in mind down the line, but you have to see how this plays out in quarters after this happens. So all in all, like we said, C plus or B minus. There's some red flags, but there's nothing glaring. And if you look at another company like an Oracle or something on their balance sheet that's bad, with a huge amount of debt that they're going to have to pay, then that's whenever you get into worrisome area. Here, it's something to keep an eye on. But the reason everything did go up is matched with acquisitions and stuff in the real world, so that makes it better, even though we have to give the balance sheet that C plus, B minus grade, if that makes sense. So if you factor everything in, maybe it's a B, B plus. So we can live with that. We like that as a company. They're backed by Pepsi, owns a lot of them. They're pretty safe. So there's so many factors that go into it. Outside, you need to know the company. But there's so many times that companies have so much debt. It's like, how in the world are you even going to go and operate and make income in the future years? And that's a huge reason why Oracle is getting sold off, because everyone's like, what in the world is this on this sheet right now? So there's just a lot to think into in matching it. But I hope you guys enjoyed this. That's kind of how we go through the income statements and balance sheets to find out the financial health of a company and the quality of their earnings and the efficiency in which they're operating, to apply that to what the management's saying. So you can even evaluate the management and find good stocks with good earnings that are triple beating and working efficiently and beating their numbers in the future. So going through this is the nitty-gritty work, but it's something you have to do for every company. You can't just not go and invest in a company because of an idea. You should find your ideas first, the qualitative why you like a company, and then you want to go through their financial statements after you've done all that research and make sure, hey, this checks out. Then look at their guidance and run your numbers. And don't fall in love with a company if they have a horrible balance sheet, because you're going to stay up worrying about them. And that's not a way to live. Find good companies with good balance sheets, good management that you can trust to be efficient on their income statement. Thank you guys for watching. If you like this video or anything, just smash that like button and leave us a sub down there for more videos in the future. We're going to be doing this huge series with how you should really go out and evaluate a company. And we hope you guys really, really enjoy all this.